Today is Monday, June 29th. This is a post-market review, and you're looking at a daily chart of the SPY index. The market had a decent bounce today and closed in the green all across the different indices. The Dow Jones Industrial Average closed 2.3% to the upside. The S&P 500 closed about 1.5% to the upside, and the Nasdaq closed at 1.2% to the upside. Here is a heat map for today's activities, and you can see that technology was a little muted, but it was green across the board, specifically in utilities, in industrials, in materials, and weaker names. Typically, the difference between a dead cat bounce versus a legitimate buying, institutional buying, is that a dead cat bounce is characterized by a low volume day to the upside, with the majority of the buying and the participation of the upside on weaker names. Institutional buying, on the other hand, is characterized by a high volume day where every stocks across the board participate, weaker stocks, but specifically stronger stocks as well. I will take you in a tour of headlines that preceded the market's opening, and then we're going to look at the action during the day and what trades we got into, and then we're going to look at what to look for the remainder of the week. The first headline that moved the market is the Boeing headline. Boeing had a big day today, and the reason is that the FAA is retesting the Boeing MAX 737. Boeing remains a very volatile name. I avoid it because every time you're going to have positive news about the 737, the stock will blast to the upside, and every time you have bad news about it, the stock will collapse down. So I stay away from it. I'm a spectator for now. But you have to remember, in bottom fishing, buying a name like Boeing for a long-term investment, say 10 years from now, is a smart thing because Boeing will recover. Boeing is one of the largest companies in America, in the world. It's a big defense contractor. The government will never let it fail. But when you bottom fish weaker names that are not as strong as Boeing, you risk the fact that these companies might go bankrupt, might go underwater. The next headline is the batch of boycotts against Facebook. It seems like every 5 minutes there's a company that announces boycotting Facebook. It is the woke thing to do, it is the trendy thing to do, and I'm not going to talk about it a lot in this video because I will dedicate a whole video into Facebook, and I will do an analysis of the stock, and you will find out that the boycotts are very insignificant, and any dip or drop in Facebook stock is an opportunity to buy. But I will show you when and how to conduct the buying trade. The next headline is the declaration of bankruptcy from Chesapeake Energy. This is the shale oil company, and of course one of the Robinhood young traders' favorite to gamble on. Well, now it's in bankruptcy, so all the bros who are saying buy Chesapeake and it's the best thing ever, it's going to recover, and all the positive scenarios that they've imagined, well, now the company is going to declare bankruptcy. I still don't understand the logic of buying weak, heavily in-debt companies and calling that smart investing. I still don't understand what the logic is, but a lot of younger rookie traders seem attracted to these cheap names. They think it's smart to buy these names for long term because of a recovery or because of whatever. But we now know that this company is going to file for bankruptcy, and we also uncovered very bad behavior from the executives in this company, from spending exuberant amounts on NBA season tickets to Botox and hair salons and wine caves or whatever else. But the executives wiped the slate clean. The company declares bankruptcy. The executives already exercised their options, they made a ton of money, and they walk on for the next scam, leaving you retail investors holding the bag and losing your money. Here is a drastic headline about the fact that half of the U.S. population is unemployed right now. Half of America is unemployed. Yet somehow I keep hearing about this fee recovery shape theory. I don't know how you do that with half of the country unemployed. Furthermore, food banks, and this is very tragic, food banks are expecting a second wave of people rushing to food banks because they don't have any income and they need food banks to support themselves and their families. It's very horrible. But this is the situation we're in Main Street. And Wall Street and the stock market is very decoupled from the realities that Americans are facing every day. Speaking of food banks, let's check out on our oligarchs, the billionaires, and let's see if they're doing okay. Oh, here we go. They made over $500 billion this year. So I guess our oligarchs are doing fine. Although somehow they need more bailouts and more Fed money for their emotional pain and suffering during this horrible tragedy. Here's another headline. Since half of America is unemployed, you know what it is. Buy Apple stock, because everybody will afford and be able to afford $1,300 phones, right? Wrong. And maybe that's why Apple, in their next release, will sell the chargers separately. You're going to have to pay a fee to buy your chargers. Phones will be sold with no chargers. Maybe it's an incentive to lower the prices a little bit to appeal to the other 50% of Americans who still have their jobs. But hey, Apple stock at all-time highs. It makes sense. And I say that sarcastically, of course. Another headline related to the COVID crisis, Planet Fitness, the operation of gyms, is down big today because of a coronavirus case in Virginia in the gym. Who would have guessed? You open the gym, people are sweating all over the place. How do you regulate the locker rooms and people coughing and sneezing all over the place? There you go. Now we have a COVID case in Planet Fitness. They're probably going to have to close the gym. And you're going to see these scenarios repeated in gyms across the country. Therefore, Peloton and home gym equipment companies are really in a position to grow here, because a lot of people who work out routinely will miss the gym and will adapt to the workout from home culture. So this is the next opportunity in entrepreneurism and in the market in general. The biggest headline of the day, of course, from Gilead. They finally released a pricing plan for their treatment of the COVID-19. I won't even pretend that I know how to pronounce this name, so I'm not gonna. But it basically cost $3,120 per treatment, which is absolutely outrageous because the research for this treatment was funded by the taxpayer. And pharmaceutical companies, and Gilead in particular, have a history in this. The taxpayer funded the research for their HIV treatment. And now they're charging people exorbitant amounts for this particular treatment. The taxpayer gets duped again. They pay to fund these treatments, and once the treatments are available, the drug companies decide to charge insane amount for it. Why did the taxpayer fund the treatment to begin with if we were going to be charged at the end? And if you're looking for explanation on why this keep happening, it's because the pharmaceutical industry is the largest contributor to lobbying in Washington, D.C. They spent over $4.4 billion the last 22 years paying up politicians so they can protect their scam. Because at the end of the day, it's a racket. It is a racket where you get taxpayer money, fund your research, and once you have the treatment out, you charge insane amounts for the people who need it the most. It's a racket protected by politicians, but it's not run by Al Capone or Lucky Luciano. It's run by a bunch of old white dudes in the executive suite. The last headline, or it's a chart actually, that came out about hedge funds moving their bearish bets into bullish. And if you look at the chart, you see the light red columns above the horizontal line. That means bullish positioning, and below it is bearish positioning. And you can see that hedge funds have pretty bad track record. So now that they're switching to the bullish side, Perhaps it is time to be bearish. Before we start the chart analysis, I'd like to remind you of the conclusion from my video yesterday. So this is what we expect. Let's say that the market opens down on Monday. That would be an opportunity to cover your shorts. If you haven't covered yet, take profits. And it would be also an opportunity to buy a little bit. You don't have to take any risks. Certainly, I might not make any trades for the week. I don't have to. But if you have to, you might see buying the dip opportunity in names like Facebook and Apple and Microsoft. But here's what I see. Let's say we open down on the SPY on Monday. I see a little bit of buying, not significantly, but I see the week ending in the green. So we look at opportunities one day at a time. And my call was spot on. We started lower and we pushed back. We started lower in the futures actually, and we pushed back and we closed in the green. It wasn't a significantly big day, but it was notable, yet you can't make conclusions from it. For now, we'll take it as it is. It is a dead cat bounce. Here's a 15 minutes chart of the SPY, and you can see the action started in the day on this green candle right here, buying from the beginning and consolidation throughout the day, and aggressive buying at the end, which also tells you that there is a lot of short covering that happened today. Similar story in the Qs, and from yesterday, if you saw the video, I recommended buying the dips in the beginning on Facebook and Microsoft and Apple because those names will bounce and pick up from last week's sell-offs. Personally, I wanted to enter a trade on Facebook in the morning, a bullish call, but I missed it. I was busy doing something else and I missed on the window of opportunity to buy that call. Regardless, here's a winner of the day. Apple stock closed up 2.3%, and it's reversing from the red candle that it had on Friday, the sell-off. It's pushing its way up. But here's the important thing about Apple stock. Let's switch into a weekly chart. Look at how it diverges from the 20 weeks moving average. It is way extended. The 20 weeks moving average is the center of gravity in any weekly chart, but specifically in Apple chart. Look at any divergence from the weekly 20 weeks average. It always comes back and visits the average before it bounces back and makes another move. Here's a divergence. It bounces back. It actually overshoots. It crosses the moving average and it comes back. The higher the divergence, the lower the correction below the 20 weeks moving average would be. And likewise, the lower the divergence of the 20 weeks moving average, the higher the shoot up would be. So right now, we are waiting for Apple to break down and visit its natural center of gravity, the 20 weeks moving average. This is not a recommendation to short right now. Don't play God yet, because when you do that, the likelihood is you're going to short an Apple stock either continues to go up or consolidates and you lose your money buying shorter put options. Wait till the signal happens. There's going to be a lot of meat on the bone for the short trade. Wait for the signal to happen. Apple could consolidate and let the 20 weeks moving average catch up to it. But it will go down and correct very soon. You just can't tell when exactly. Matter of fact, let's measure the divergence here from the 20 weeks moving average to the top. And it's about 24%. That's just unhealthy for any stock to diverge on a weekly basis from its 20 weeks moving average by this amount. As far as trades, it was a slow day. I only opened 2 trades. The first trade on the VIX, the UVXY, I bought the $40 call, and that's expiring next week because this week's going to be a shorter week. So it's an opening position. I will construct it as I go. I might turn it into a spread. I might close it if I see other signals or take a loss. It depends on how the market will operate. But for now, we open this position for $285 per contract. And if you look at the VIX chart, remember, I maintained the position of buying dips on the VIX, and it was a very rewarding strategy the last few weeks because this is a significant move to the upside. And historically speaking, as we explained in past videos, when you have a significant breakout in the VIX chart, you don't have a one leg and then collapse down to normal range again. You're usually accompanied by a second shock that happens, and this move is too small to complement this very large move. So I anticipate that the VIX will consolidate here, collect some energy, and pop to the upside at some point. Here's what I know I'm wrong. If the VIX continues to collapse, closes the gap right here at around 27.5, and then close below the line right here on $25, because it goes back down to its normal range, and that would be a sign that the fear, the volatility is winding down, and it's a very bullish signal for the stock market. So that's the point when we know not to buy the dips on the VIX and switch to bullish positioning in the stock market. The last trade that I had open today is a short, a put option for the 24.5 expiring this week, this very short week. So that's why it was a very timid trade, very small. It's just a wild shot on Wells Fargo. And ironically, at the end of the day, we had news from Wells Fargo that it is expected to cut dividends in the third quarter because of the Fed stress results. Remember, I said that it is a warning signal that the Fed is hiding the results of the stress test it conducted last Thursday. And I hinted that the reason is that Wells Fargo as a bank is in trouble. And now we're seeing that prediction is coming to fruition. I didn't know that they will cut dividend after market. Otherwise, I would have made a bigger position. But it is a trade. We'll see how it ends. I will update you on it. So, let's conclude. Remember that this week is a shorter trading week due to the 4th of July weekend. So Friday will be off and the market will not be open. The next thing to remember that historically speaking, the week leading to the 4th of July holiday is bullish, has an upside bias historically, at least the last 4 to 5 years. It is also a low volume week, which favors the upside, favors the bullish side. There's not a lot of selling. There's not a major stakes going on this week. Mostly a little bit of short covering, a little bit of buying, a little bit of trading. So the bias goes to the upside. Absent of a disaster in the news, something major, I do not expect the market to break to the downside. But you know the environment that we're living in with COVID and everything. A disaster piece of news could happen any day. Lastly, we saw a move in the garbage stocks, the airlines, the casinos, the hotels, the cruises. They're moving to the upside. It's a combination of dip buying and short covering. I don't recommend to short the rip right now. There's probably a little bit more to the move, a little bit more to the dead cat bounce. We might short the rip at some point later, but not right now. I recommend shorting the banks. The banks are absolute garbage. The delinquencies are rapidly rising. Interest rates are likely to go negative. The Volcker rule is easing, meaning that the banks will gamble more. They're probably going to raise fees on their customers. They're getting disrupted by fintech. The outlook for the banks is very, very negative. I don't like it. I never liked the banks, and I like them less right now. If you found the information in this video helpful, please subscribe, share, and like, and don't forget to follow me on Twitter.